Good evening to all of you and welcome to our Q3 fiscal 19 results announcement. Let me start with a quick update of our last quarter's performance. I'm very happy to share HCLite's delivered an outstanding performance with a strong growth of 5.6% quarter-on-quarter constant currency growth and a 13% year-on-year constant currency growth. The growth last quarter was across our entire suite of products and services. The industry-leading performance is a great reflection of excellent execution from 132,000 HCLites with a very strong entrepreneurship DNA operating from 43 countries. We had strong performance across our Mode 1, 2, 3 offerings. Mode 1 grew by 3.9% quarter-on-quarter. Of course, all of these are constant currency numbers. Mode 2 grew by 13.1% quarter-on-quarter, and Mode 3 grew 6.2% quarter-on-quarter. Our EBIT margins remained in the guided range of 19.6%, 30 basis points below the last quarter. Coming to our segmental performance in terms of our service lines, our Mode 2 business crossed an important milestone of $1.5 billion annual run rate. We continue to see strong acceleration in our digital business, which is really reflected in a double-digit QoQ growth in our Mode 2 segment. Our combined Mode 2 and Mode 3 revenues stands at 29% of our overall revenues. Our Mode 1 business continued to show steady growth, led by a robust double-digit quarter-on-quarter growth from our infrastructure services, which is 10.4% sequential quarter-on-quarter growth and a 16.5% year-on-year in the infrastructure services, followed by our engineering and R&D services, which grew 5.1% quarter-on-quarter and 17.4% year-on-year. The growth momentum was possible due to flawless execution of some of our large transformational deals, which have moved into a significant execution phase. From a vertical perspective, 4 of the large verticals delivered more than 20% year-on-year growth on a constant currency basis. These are telecom, technology and services, retail CPG, and life sciences and healthcare. All of these grew more than 20% year-on-year. Energy, utility, and public services posted a decent 8.1% year-on-year constant currency growth. Financial services and manufacturing had a muted performance on a year-on-year basis, which is expected to pick up in 2019. In terms of geographies, all the 3 geographies delivered double-digit year-on-year growth. Our US business grew 12.9% year-on-year. Our Europe business has picked up momentum. It's grown 14.5% year-on-year, and our rest of the world grew 12.1% year-on-year, excluding our India business. Most of our growth in US was from life sciences, retail CPG, technology and services segment, and telecom, media, and entertainment verticals. Moving on to the deal trends this quarter, we once again had the highest booking this quarter, driven by financial services, technology and services vertical, and manufacturing vertical. As you would know, this is the second quarter in this fiscal where we are recording highest bookings. We brought home 17 transformational deals across service lines, geographies, and verticals, which helped in achieving a record high booking for the second time in this fiscal. The deal wins augurs very well, and we're confident it will deliver good contribution to our organic growth in the future. Also, as I look at the healthy demand environment for technology offerings in the market today, I believe our investments for the last 10 years in building global delivery centers outside India and nearer clients is really putting us in a very strong position to address the accelerating demand for technology services in some of our largest markets. We today have 134 delivery centers outside India, and 61 of them with capacities of 100 plus to some of them over 1,000 plus people capacity. Of the 61, 23 centers are in US, positioning us very well to service the increase in demand in one of our largest markets. We've also had one of the highest localization rates across the industry, and this again helps us to deal with the fluctuating supply and demand scenarios that arise due to economic, geopolitical, and other constraints. Before I close my commentary, I want to update you on the theme of HCL 2030, which we unveiled at World Economic Forum in Davos last week. HCL 2030 is a platform to really bring the thought leaders, industry experts, clients, partners together to debate about what is the future of technology, how will it impact businesses in the next 10 years, and really creating an enabling platform to discuss what we call as technology for the next decade today. It was a roaring success. We had several thought leaders coming into the HCL Pavilion at World Economic Forum, very stimulating conversations across artificial intelligence, machine learning, how human and machine intelligence can come together to create the next wave of growth and differentiated business outcomes and better quality of life that will be enabled. So this was really a very encouraging and very stimulating platform where HCL brought together several thought leaders to debate on this point. In summary, we have executed our Mode 1, 2, 3 strategy very successfully to create the best mix of products and services, which is quite viable and growing in any economic conditions, be it deceleration in economic growth or uptick in economic growth. I think we have a great mix. Among the tier 1 service providers globally, we believe we have the great mix of products and services to weather the storm. All this has been made possible by unrelenting commitment by our employees, whom we call ideapreneurs. They've delivered best outcomes, best in the industry outcomes for us. With the confidence in the bookings that we've had and the demand environment, we feel confident of delivering towards the higher end of our guidance. We had guided for 9.5% to 11.5%. Last quarter, we said we will come around the midpoint of the guided range, but given the outstanding performance this quarter, we are guiding towards the higher end of the guided range. With this, I will hand over to Prateek to take you through the next level of details.
Yeah, so we have a quarter which is outstanding by all respects, I think. Like CVK already talked about, we have a 13% year-on-year organic growth, constant currency growth, which is, at stable 19.6% margins. I would like to draw your attention to a few metrics that I have put in my quote, which I want to keep talking about, because that is very important metric which we track. The first one is cash EPS. It is nothing but EPS, but adding back all the non-cash items that are there in the P&L. And that stands at 82 rupees on an annualized basis for this quarter. 82 rupees per share, per equity share. And that is a good 11.4% growth year on year on a last 12 months basis. So calendar year 18 versus calendar year 17, that's 11.4% increase and standing at 82 rupees for the last 12 months. A couple of other things which we want to highlight is the return on equity, which continues to be at 25% plus. And the third metric I want to draw the attention to is return on invested capital, capital that is invested in the business. We are delivering 28.7% return on invested capital. With that, I'll throw it to Darren.
Great. Thank you, Prateek. So from a Mode 3 point of view, it was a solid quarter. We continue to make good progress executing on the strategy that we've outlined over the course of the last several quarters. In terms of the product portfolio, our playbook is really underpinned by a few common elements. The first is focusing on customer success. The second is sustained focus around modernization and innovation and investing in that in our product portfolio. It's working with a set of IP partners, continuing to partner successfully with them, enabling them to be successful, and enabling their customers to be successful. And then on the back of these IP partnerships, continuing to make progress in terms of the rollout of new derivative works that we're rolling out across the HCL channel. This quarter, we're very proud. We rolled out 9 additional new products available to HCL customers. These are new solutions primarily across the DevSecOps area, in testing, in application security, around DevOps. And these are some of the areas that we see tremendous resonance and opportunity to bring new solutions and new value propositions into our customer base, both through selling as individual products, but also combined with services to really bring new solutions and new innovation in an integrated package. Finally, in terms of the highlights for the quarter, as most of you are aware, in December we announced the definitive signing of a $1.8 billion acquisition of 7 products from the IBM portfolio. We believe that this will be a very good foundation as we continue to build upon this strategy in the quarters to come.
Yeah. Welcome and good afternoon to all of you. A bit of a narrative on the people front. So this quarter, our net headcount has increased by 4,453 people. And our attrition on a last 12-month basis has increased by 70 basis points, but on a quarter-on-quarter basis, which is the real metric, we dropped the attrition by 120 basis points. We are continuing our trajectory of coming down on the attrition. So we hope to end up at the same level as what we were last year by end of this quarter. And our focus on gender diversity has yielded very good results, and we will continue to focus on that. In the last 9 months, we have improved our gender diversity by 1%. And especially at the leadership level, we almost doubled our leadership layer in gender, which is a metric which we are really proud of. And going forward, we will continue to focus on that. And coming to the training part, so much growth happening, so many opportunities on the table. We are not going to get skills at scale at an affordable price unless otherwise our training engine kicks in. So this year, this quarter, the quarter that has gone by, we have done 31,000 FTEs have been trained on generic skills, and 36,000 people are trained on digital skills. And we are not only training them, we are also focusing on how we are able to convert these people into positions. And that has shown a dramatic improvement of 20 to 25%, a 5% improvement over the last quarter. So we are looking at what is the demand that's on the table and looking at what demand is anticipated, and we are training our people so that we don't have to run into the market for every position that is required. Coming to localization, Vijay briefly mentioned about it. We continue to improve on our localization. We were at 64.7% in US last quarter, and this quarter we are at 65.6. By far, we are the highest in terms of localization among any of our global peers. So that journey continues, and with so many delivery centers that we have started over the last 2 to 3 years, and our focus on fresh talent and fresh graduates hire. So we are trying to hire around 2,000 people in the next financial year outside India, and around 10,000 fresh graduates in India. So there is a huge amount of focus we are putting in terms of localization efforts. And as briefly mentioned, the theme HCL 2030, lot of our artificial intelligence and machine learning, NLP are coming into play, and HR is no exception. In fact, we are the first port of call in terms of implementing these technologies. Today, we have automated all our talent acquisition pipeline. So from matching the CV to interview and throwing up the offer letter, we have integrated the whole thing in an automated manner. So we are going to roll it out globally by March. So India, we will finish it next year. So our focus on automation is one of the highest in terms of how do we reduce the touch points so that people have a good experience. Thank you. I pass it on to Vijay.
Yes. With that, we can take questions from the audience, followed by questions for the participants on the phone. Yes.
Hi, Leroy from Cogensis. So the thing is, your rest of the world growth rate is around 8.4. You are saying by excluding India, it's 12.1. So I am expecting that it's probably negative. So will this trend become bigger? How do you see the India business from here?
Yeah, we have pretty much articulated this over the last couple of years.
Yes.
In India, our focus is on only selective areas where we want to do business in. We are not participating in large SI projects. That's really part of our strategy. And the numbers reflect our strategy.
So what's the decline in Indian business in October?
I don't have the exact number, but the whatever 8% growth includes India also. And without India, it's 12.2. You can calculate the numbers. It's pretty straightforward.
Okay.
Hello, sir.
Yes.
Varun Sood, Mint. 3 questions, please. Firstly, can you just share what you see on the demand outlook front, especially in the US? Is the continued shutdown in the US really impacting any of your client budgets, or any macroeconomic slowdown playing down in your client conversations? Any kind of demand commentary for Q4 and for FY'20, please? That's the first question, sir.
Specifically, we haven't seen any impact of government shutdown on our business. A couple of areas where we are dependent on the government would be on the visas. We've not seen any delays at all. It's pretty much on track. So we've not seen any shutdown impact as such. In terms of overall demand environment, it continues to look very positive because of 2 reasons. One is some of the spend which customers were doing, which maybe a couple of years back you could term them as discretionary areas of spend around digital and some new projects, today is no longer discretionary. Every CEO whom we meet is emphasizing more and more on the need for them to accelerate their investments in their digital transformation. So even if there is a slowdown, or even if there is a little bit of downward curve, I do believe a lot of the forward-looking companies will continue to invest in digital transformation and see how new technologies can be used to leverage differentiated business impact and create differentiated business models. However, we keep our eyes open. I mean, of course, because of trade and things like that, in some geographies there could be decline, which may impact our customers. But so far, I have not heard anything specific.
The second question being, at the start of the year, you had guided for at best 11.5 constant currency. 2 quarters, like you are saying, you've had excellent order bookings. Can you please quantify what is this kind of order bookings you've had? And B, if you've really had 2 quarters of excellent order bookings and what looks like to be a fantastic growth, why are you not really improving upon your guidance? Why after the 3rd quarter also you are retaining that guidance of at best 11.5%?
Yeah, so guidance had a range of 9.5 to 11.5. So that was what was visible at the beginning of the year. 2 quarters into the year, we said we will be at the midpoint, which was demonstrating the increased booking reflection of that getting into execution. And today we are saying we are moving towards the higher end of our guided range. Right? So I think all the good booking, all of that is getting reflected in this. And we've had 2 good quarters of highest booking in the fiscal, so which augurs very well for FY'20. So we remain pretty optimistic about what we can do in the next year, as well as the next quarter.
If I can add, Varun, when the June quarter, we announced that at that point of time, that was the highest ever booking. It does take a quarter or 2 to flow into the numbers. So June quarter booking has really flown into the numbers now, or at least most of those deals. And therefore, what we are announcing today in terms of bookings and deal wins would probably not come in March quarter. It would come into the next fiscal.
Thank you, sir. Can you quantify what's your TCV wins, if I have to ask you, in a quarter? Because many of your peers do that. So it just helps understand, sir.
Yeah, so we also used to do that, but we no longer do TCV wins as a overall number. And something more definitive is the guidance, because all your wins and TCVs, all of that should get really translated to executable action plan, which goes into your revenue projections. So that's why we've been giving guidance for the last 3 years, and we stopped giving specific numbers on booking. However, on a qualitative perspective, this is the highest booking, which is, again, should be a good reflection of how we are doing in the market.
So last question being on infrastructure services. For the longest time, infra was a little wobbly. You've done double-digit growth. Is the worst behind you, especially with the impact of cloud and the migration from in-house data center work? Is the worst behind HCL, and can we now see a sustained double-digit growth in infra services for the coming quarters, sir? Thank you.
I think our overall confidence or optimism on infrastructure services was always there. We had some specific reasons why there was a little bit dip over the last few quarters, and we said towards the first half of this year, which was last quarter, we said we will have a decent growth, which happened. Now this quarter has been a double-digit quarter-on-quarter growth, year-on-year 16.5%. So I do believe our growth momentum will continue. Whether it is going to be double-digit or single-digit, I don't want to comment. And I also don't want to comment on a quarter-on-quarter perspective from an infrastructure business. Due to the nature of deals, it would be lumpy. So the right metric to really look at is year-on-year performance. And I would say we're continuing to feel optimistic about the infrastructure business without giving you a number. And when we give the guidance for the next year, we will try and give it some dimension, not now. So if there are no questions in the audience, we can take questions from the participants on the phone. Over to you, operator.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and session on the audio bridge. If you'd like to ask a question, you may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may please press star and 2. Participants are requested to use handsets while asking a question. Participants on the audio bridge may please press star and 1 at this time. The first question is from the line of Sriram from Mint. Please go ahead.
Hi. 2-3 questions. First one, operating profit margin seems to have softened a bit on the sequential basis. Can you give some color on that?
Yeah, Sriram. So operating margin is down about 30 basis points versus last quarter. While there are a number of moving factors, I would say this is largely driven by some of the wage increments during the quarter. That's the largest impact during this quarter.
Okay. Second question, even though you don't want to give out specifics, can you give some color on how has been the deal pipeline and bookings have been compared on YOY basis, like how same quarter of FY'18 fared and how you did it in Q3 of this quarter?
So I think that's an excellent question, Sriram. So 1 year back in December 17 quarter, we called that quarter out as the highest ever booking quarter, the highest ever quarter of deal wins, until we sort of came and reverted 2 quarters later, that was in June 2018, that then became the next highest quarter, the highest quarter ever. And we are happy to announce 2 quarters again later. So what I'm painting for you is a period of 5 quarters with 3 peaks, and you can see where the graph is going. I'll leave it at that.
Yeah, that's it.
So would it be like, let's say, significantly higher than the year ago period? Like, how do you term it?
Yeah, that's obvious. If you had 2 quarters of highest booking and 3 out of the last 5 quarters, even on a YTD basis, the booking would be significantly higher than the prior period.
Okay, so one last question. If you strip out the benefits from the acquisition, how has the organic revenue moved in constant currency terms?
So, Sriram, again, I'll go back to the guidance we gave at the beginning of the year, and we talked about the midpoint being comprised of roughly 50-50. When we talked to you last quarter, we said slightly less than 50% of that 10.5. So let's say a number, something like 5% is where the inorganic was coming in because some of the things got delayed, etc. Something we anticipated did not happen, etc. So now when we are saying we are going to be towards the higher end of the range, which is, let's say, towards somewhere around 11.5, inorganic continues to be around that 5%. So you can count the balance, which is close to 6.5, is actually coming from organic.
Okay, sir. Thank you. Thank you very much.
Thank you. A reminder to the participants on the audio bridge, if you'd like to ask a question, you may please press star and 1 on your touchtone telephone.
So thank you, operator, and thank you all of you for joining us today, and look forward to interacting with you during the next quarter, which will be the end of the year, and we'll talk about the new year. Thank you.
Thank you very much.
Thank you. Thank you.